Hey everybody, Colin Harper, and I'm joined by Brian Peluso over here, and we've got Michael Kutch down in the Sunshine State, which apparently I'm very jealous of today, as winter has arrived in Pittsburgh, that's for sure. We're going to talk about a couple things today, a lot of which may be your favorite topics of discussion around the Thanksgiving dinner table. We're going to talk about politics.
Oh, yeah.
We may throw religion in there, and we'll definitely talk about finances. So
that's the trifecta.
This is a trifecta.
For those of you who might want to drive a few guests out of your home during Thanksgiving, pick one of those three or all three, and it could be an early departure from the dinner table.
I was telling Mike, soon to become, anyways, so moving on, Mike's going to talk a little bit about the markets. We do have some political stuff to talk about, mainly how it relates to the markets.
Yeah.
But just some housekeeping items. Next week, next Friday's, Black Friday, we will not be having Friday Live then. So if you tune in next week, we won't be here. I'm sure you have plenty of other things to do more exciting than watch us next Friday, though. So enjoy the time.
And watch football.
Nap and watch football, absolutely. So enjoy the time with your families, relax. Nothing we say here is meant as specific recommendations for anybody. And Mike, if you want to kick it away, let us know what you're seeing out there, and then we'll kind of tie that into what we're seeing on the political side of things too, and what we think maybe 2023 going forward could look like.
Yeah, absolutely. So the S&P 500 is a little lower for the week. Today hasn't finished, but it looks like the green has turned slightly red. On Tuesday we got the PPI report, the producer price index, which kept the rally intact on Tuesday, and it kept the theme that peak inflation was confirmed for the month. Now, it's great that both the PPI and CPI, the inflation data, showed some deceleration, but they're still at historical levels, and much work still remains on the inflation front. Then on Wednesday, the rally stalled out on pretty strong retail sales. You may ask why a good report is bad for stocks. The simple answer is that means the Fed's going to continue with their aggressive rate hikes. That was confirmed from the Fed speak we got this week. Most notably was James Bullard, who stated that he believes that the Fed funds rate needs to get to a range between 5 and 7%. That was a shock to me in markets. The market initially sold off on the remarks. Just to put it in perspective, a 7% Fed funds rate, especially in this short amount of time, we were at zero not even 12 months ago. That would probably put us in a pretty deep recession. However, I do want to point out that he is one of the most hawkish members of the Fed, and he will not be a voting member in 2023. December is going to be his last voting meeting. So one hawk will be removed, but we'll see if the rest of them kind of get up to that. I think it's realistic now at this point. We probably get close to 5% on the Fed funds rate.
You got to be careful about those hawks. I'll tell you, we bought Gabby a little toy hawk that makes noise when we were on vacation out in Zion, and I haven't been able to ditch that thing since we got home. All I hear is that chirp about 100 times a day. So you got to be careful with those hawks.
Oh, you got
to buy her a dove.
Yeah.
I should have bought her a dove.
Yeah.
I should have bought her.
Only doves and bulls from here on out. I'll get into the technicals a little bit if you can pull up that chart of the S&P 500. So we've kind of been in the 3,900 to 44,000 range on the S&P 500. This week we got as high as like 4,028, which is a retracement level. The Fibonacci 61.8%. That's why it's not a round number. I think this rally could have some further to go. I wouldn't be surprised if we got to the 4,060 to 4,100 range. If you see on the chart, that's the downward sloping 200-day moving average, and then slightly above that is pretty much the downtrend line that we've seen so far this year. Anything above that is going to be a little tougher. You would have to have the inflation prints really go our way and the Fed kind of move closer to that pausing stance. Now, on the downside, if we break that lower level there, 3,900, the chances of making new lows would increase. But overall, it's been a very challenging market. Everyone knows. But with these bear markets, you can have these massive melt-up rallies like we've seen the past month or so. And it doesn't need much good news to spur one of those. And on the economic front, we really haven't seen that much deceleration yet outside of housing. However, we've had such a move in that Fed funds rate and more to come next year. It's eventually going to work its way into the economy. It just seems like that runway has gone on a little longer than most people thought. You look at the yield curve, it's flashing warning signs of potential recession. The 2-10 Treasury yield curve, it's been inverted for about 6 months now. That stands at negative 70 basis points. That means the 2-year Treasury yield is 0.7% higher than the 10-year. It's not supposed to be that way. The 3-month to 10-year, which is a more accurate predictor of a recession, that's also inverted. That's about a negative 0.5% or so. So my best guess is we're going to see more downward revisions in earnings over the next few quarters, and then that's going to seep into consumer spending. And the last leg of the economic front to fall will be the employment situation. So I think it's likely we'll see the most significant deceleration in the back half of 2023. But as we all know, the stock market is forward-looking, so I think we could find that bottom sometime between first and second quarter. I'm not necessarily saying we have to make new lows, but we'll probably get back down to that range before we kind of have a sustainable bottom.
Thank you, Mike.
Mike, is it fair to say, we've talked about this before, I'm just going to reemphasize, maybe you can address it a little bit, the difference between what the economy is doing and what the market is doing. Is it possible that we get negative news on all of our favorite news sources throughout the year, but hopefully maybe the market kind of starts to do its own thing? So we might live in an atmosphere where there's negative economic news, but maybe the market kind of does its own thing and goes in a different direction than that negativity at some point in 2023?
Yeah, certainly possible. So in the beginning of next year, you're going to start to see some deceleration in economic activity that the market will take as good news, because in the short term, that means the Fed's probably going to pause sooner than later. Then they're probably going to have a period where it starts to seep in that, the chances of a recession are rising. They might get a little freaked out, but the stock market tends to bottom 3 to 6 months before the economic numbers. So the stock market will start to come up most likely before the economic numbers really bottom.
Fair enough. Speaking of negative and good news, let's talk politics.
I love politics. It's going to be great.
So this is November 18, 2022, and we have finally gotten some clarity on the balance of power in the United States. And so this is the way it's going to work out unless something extreme happens. Obviously, we're going to have a Democratic president in Joe Biden. It appears that the Democrats will maintain control of the Senate, but the House of Representatives has flipped to the Republican side. I actually will have a YouTube video with some more details on what it has looked like historically when we have a unified government, meaning the president, Senate, and House are all of the same political party, versus divided, which means some version of that, either the president, the Senate, or the House, they are not all the same party. But I wanted to bring up a couple things, and Colin, if we could bring this up. Now, this comes to us from HartfordFunds.com. And in conjunction with some research they did with Morningstar. Now, I should say we have Hartford funds and ETFs available to us. We have no incentive to utilize them in our clients' portfolios over other great investments. If it makes sense, we can do that. But I found their research to be particularly interesting. And we can see this page right here where it says 2023 could be a good year. Obviously, past performance is no guarantee of future results. But if we just go back into the history a little bit, and Colin, if you'll scroll down here, this is from 1950 to 2021, looking at the average returns of the S&P 500. The S&P 500 is an unmanaged index of 500 of some of the largest companies in the country. This is what happened on average from 1950 to 2021 in a 4-year presidential term. And you can see clearly that third year has the best numbers of all 4 years. Now, these are averages. if you look at this average over 1950 to 2021, it says the second year should have been 9.2. Mike, do you think we're going to end up the S&P positive 9.2 this year?
I think only if we get a miracle.
Okay, it's possible. So what you're saying is there's a chance.
Saying there's a chance.
So obviously these are averages, but clearly what we're seeing is that the third year tends to be the best. And not only that, if we could scroll down a little bit more, what happens in the third year post midterm elections, which next year, 2023, will be Joe Biden's third year as president. We just concluded midterm elections, and you can see each of the different observations. But what I'm going to highlight is in the lower right-hand corner. On average, from 1950 to 2021, this is the S&P 500, according to Hartford Funds and Morningstar. On average, 1 year out from the midterm elections, averages 15.14, whereas all other years are 7.14. More than twice as much of the return of the average year is the 1 year beyond the midterm election. And again, there's so many things that have gone on in the world from 1950 to 2021, but kind of like some of the things that Mike's looking at could be a trend. Maybe we're not going to hit exactly these averages, but there generally appears to be, on average, some positivity in the third year of a presidential term and after midterm elections. But kind of going back to what Mike was talking about, we might not see all of that in the first quarter or the second quarter. We're going to really have to wait to see what 1 year for the midterm election will hold. Why are these numbers important? I can assure you that many of these presidential terms and post-midterm elections, many people said this did not go the way I think it should. I'm not going to invest. It's going to be terrible. I'm going to sit on the sidelines and wait. For many of those people, you run the possibility of just missing out on these things. You take the good with the bad. You make sure you have a good financial plan with strategies and investments that meet your short, intermediate, and long-term goals, and you stick with that plan and monitor it regularly. But, if we're looking at history, if it's any guide to us, maybe the third year and post-midterms could be okay. And again, I'll have a YouTube video on this with some more details that you can check out early next week.
No, and I think that's a great point, Brian. And those technical charts we were looking at with Mike earlier, right? We see pretty big moves, especially the last couple of weeks in the market. And I think that's a really important point that, people kind of get bogged down in the negative news, but they don't realize that the best days in the market are often preceded or followed by the worst days in the market. And just missing out on a couple of those can have a very negative impact on your long-term goals and objectives.
Without a doubt. Also have a YouTube video on this that is available on our YouTube channel, talking about why many investors underperform their investment, because the investment remains invested or many investors jump in and out of that. So,
well, I know there was a study, and it's been alluded to many times. I haven't been able to track it down. So this might not be 100% accurate, but there was a study done that showed that the best performing accounts at a particular mutual fund company were people that forgot they had the account or had passed away. And I know I have seen this before, and I had trouble tracking it down for our conversation today. But that just goes to show that if you kind of come up with a good, solid foundational plan and you stick to it, you will wind up farther ahead, all things being equal, than trying to make timing decisions.
Yeah. Oftentimes that is true. And to the timing decisions, a lot of people around politics have a knee-jerk reaction. So that might not be the best strategy for you.
The only timing decisions we'd encourage you all make is when to take that turkey out of the oven on Thanksgiving, and make sure you give it enough, not too much. We don't want a dry turkey.
No.
We don't want a what's the big Christmas movie with the turkey that just explodes?
Oh, that was a Christmas Vacation.
Christmas Vacation. No Christmas Vacation turkeys for you.
No Griswold turkey.
No Griswold turkey.
Did you see they made a sequel to The Christmas Story?
They made a sequel to The Christmas Story, and I missed it.
Is
it any good?
I haven't seen it yet.
It's just not. It's not.
I don't know if that's a good plan. I did see that the original Christmas Story house in Cleveland is now up for sale.
Really?
Yeah. So if anybody's in the market,
Does it come with the lamp or?
I did not see. That's probably negotiable.
Probably negotiate. That's fair. But I would encourage all you that are kind of listening and tuning in. As we approach this holiday season, spend time with your family. If your finances are getting to a point where they're starting to detract from your enjoyment of spending time with your family because you're worried about them, give us a call. That's the role we fill. We want to free you up to be able to go spend time with your family, enjoy life, and let this happen in the background. That's the folks we work with the best. And if that's your situation, we'd love to have a chat with you. So we won't be here next week. Have a fantastic Thanksgiving, safe travels. I know everybody's about to start heading all over the place. I think we're all going to bolt out of here shortly as well. Our office will kind of have mixed hours next week due to staff traveling to see family and things. We're certainly available if you need us, but just realize we'll probably have some limited hours next week. And have a wonderful, safe, happy Thanksgiving. Thank you, Mike. Thank you, Brian, as always.
Absolutely.
Great time. And take care, everybody.
All right, bye.